So guys, here's a quick revision of accounting standard 13. The first thing that we have covered guys in AS-13 is the definition of the word investment. I said investments are nothing but assets held by an entity for the purpose of generating income by way of dividend, interest, rentals, capital appreciation or some other benefit accruing to the enterprise. They should not be something that are being held as stock in trade. If you're holding something as stock in trade, it means better it is for the purpose of your business activity. If it is for the purpose of your business activity, guys, it cannot be termed as an investment. The common examples of investments would be investment in equity shares, investment in debentures, preference shares, investment in gold, silver, bonds, government securities, guys. Investment in immovable properties also. An immovable property, I told you, would be classified guys as an investment if and only if it is not intended to be occupied for the purpose of your business activities. If you're holding an immovable property better for the purpose of your business activities, then it becomes property, plant and equipment covered under accounting standard 10. It will not come under accounting standard 13. Now, as far as the non-applicability part is concerned, under accounting standard 13, guys, it does not apply to anything that is being covered by another accounting standard or to specific institutions. जैसे बेटा recognition of dividend income, recognition of interest income does not come under accounting standard 13 because that comes under AS-9, revenue recognition. And then guys, anything in relation to leases comes under accounting standard 19. It doesn't come under AS-13. If you have any investments which are made by retirement funds, mutual funds, banks, insurance entities, they are not again covered by accounting standard 13. As far as the categorization of investments is concerned, we have three categories of investments. Prima facie only two categories of investments. We have current investments and long-term investments. A third one was added, which is called as your investment property. As far as current investments are concerned, guys, there are two conditions. They should be readily realizable and the intention to hold them should not exceed 1 year from the date of investment. Liquidity is also important. Now, if any of these conditions is not satisfied as such, it will become a long-term investment. Investment property are also long-term investments only, guys. They cannot be classified as a current investment because it is investment in immovable property, which cannot be considered as readily realizable. So investment property will be your investment in property, land and building, guys, which is not intended to be held for the purpose of your business. As far as valuation of investments are concerned, guys, I told you any asset initially is always recognized at cost. Doesn't matter which asset it is, investment, inventory, fixed asset, everything initially will always be recognized at cost. Subsequent measurement of these investments, that is as on the balance sheet date, will depend on how are we deriving economic benefit from the investments. If your objective is to sell the investments in the near future, that is current investments. Current investments are intended not to be held for more than 1 year, guys. So you are going to derive economic benefit by selling the current investment. That is why valuation on the balance sheet date, guys, will be at cost or fair value, whichever is lower. Long-term investments, guys, are normally valued at cost. However, if there is a decline in the value of investment other than temporary, you will have to make a provision for the decline in the value of investment. The reasons, guys, which indicate that the decline is not temporary, guys, will be losses being incurred by an entity, guys, or cases being filed by against the company, or you losing trademark case, patent case, guys. All of this will signify that the decline is not temporary. If there are market fluctuations in the prices, they will all be considered to be temporary fluctuations only. They will not be considered as permanent decline. Are we clear, guys? So long-term investments, when they're normally valued at cost, you do make a provision for decline in the value of investments only if the decline is other than temporary. Subsequently, if there is an increase in the value of investment and such increase as such, guys, is not temporary, then what do? You can increase the value of investment as such, guys, and then increase it only but up to the amount of cost. Next, guys, investment properties should be valued as such, guys, as per the cost model which is prescribed under AS-10. That is the only thing given. Now for this, you should know what is cost of an investment, and then you should know what is fair value of an investment. As far as cost of an investment is concerned, guys, I said it includes anything that you are paying for the acquisition of the investment as such, guys, including the amount of brokerage, including any commissions, guys, or incidental expenses directly related to acquisition of an investment. In case you're acquiring an investment by issue of shares, I gave the example of Zomato and Blinkit, then guys, the fair value of the shares issued itself will be the cost of investment acquired. In case you're acquiring shares investment by giving away some other asset, then it is fair value of the asset given up or the fair value of the investment acquired, whichever is clearly evident. After that, beta, we did the concept of pre-acquisition income. I said in case you're receiving pre-acquisition income, beta, from an investment, that is income which relates to prior to the date of acquisition, you're supposed to reduce that dividend income from the cost of investment. Yes or no, guys? In case there is post-acquisition income, you directly transfer that to profit and loss account. When it comes to rights shares as such, guys, I said there are two options available with the investor. Either you subscribe to the rights shares or you sell the rights. In case an entity chooses to subscribe to the rights shares, guys, whatever is the amount paid will be added to the cost of investment. In case you decide to sell the rights, the treatment will depend on if the shares are acquired. Take 2 minutes here. If the shares were acquired, guys, on a come right basis or an ex right basis. If the shares were acquired on a come right basis and on account of rights as such, guys, there is a reduction in the value of investment below its cost, then to the extent of such reduction, we are supposed to adjust the sale proceeds against the cost of investment. The excess amount will be transferred to profit and loss account. If nothing is given, by default, the sale proceeds of rights beta will get transferred to profit and loss account. This is what is covered under cost of an investment. After that beta, we did reclassification. In case a current investment is reclassified as a long-term investment, current investment to long-term investment, this happens when an entity changes their intention of holding an investment. The reclassification should be done at cost or fair value, whichever is lower. Alright guys, this is to ensure that the entities do not avoid booking losses. That is why it is at lower of cost or fair value. If a long-term investment is reclassified as a current investment, L2C, 2 C's beta, it should be reclassified at cost or carrying amount, whichever is lower. Lower of cost and carrying amount when it is long-term to current investment. After that, we have learned about disposal of investments, guys. In case you're selling an investment, whatever is the resulting amount of profit or loss should be transferred to P&L account. In case only a part of the investment is sold as such beta, you will have to determine the cost of the investment sold using weighted average method under accounting standard 13. However, there were a lot of questions that we have done under investment accounts where we did FIFO method, guys. The reason is simple. In case you hold shares or debentures as stock in trade, guys, then AS-13 is not applicable. You can use the principles that are given for inventories under AS-2 and current investments under AS-13 for valuation. That is why we can either follow FIFO method or weighted average method. Alright kids, after that there were only normal disclosure requirements. When it comes to investment in equity shares, guys, I told you whenever we receive bonus shares, we are supposed to increase the number of shares without writing anything in the amount column. Whenever we are receiving dividend, if it is interim dividend, dividend relates to the current year. Because dividend relates to the current year, it is assumed to be post-acquisition dividend and directly it will get transferred to profit and loss account. When you say transfer to profit and loss account, you write it in the dividend column. Then the balancing figure of that dividend column beta will get transferred to profit and loss account. In case you're receiving final dividend for the previous year, you will have to check whether you were already holding shares during the previous year or did you buy the shares in the current year. If you were already holding the shares during the previous year, guys, then it becomes post-acquisition dividend. You will again write that amount in the dividend column. If the shares were acquired during the current year and the dividend relates to the previous year as such, guys, then it becomes pre-acquisition dividend. You write it in the amount column on the credit side so that you end up reducing it from the cost of investment. Alright. Usually when nothing is given and you're dealing with equity shares, guys, we normally assume that it is weighted average method and not FIFO method, because bonus shares will directly impact better the cost of the share. That is why it is better to assume that it is weighted average method and not FIFO method. Also better when we did the first few questions of investment and debentures, guys, the problem of pre-acquisition income, post-acquisition income does not arise because at the time of acquisition, at the time of sale only, we segregate the accrued interest component and write it directly in the interest column. We can do that because debentures are entitled to a fixed remuneration, fixed income as such better, and you exactly know what is the amount of income that is accrued till the current date. That is why every time a purchase is made, every time a sale is made, beta, you will compute accrued interest component and write it in the interest component. If nothing is specified, I told you beta under investment in debentures that the quotation is on an X interest basis, not on a cum interest basis. Brokerage given will apply either on the X interest price or on the cum interest price as per the quotation given. Are we all clear about this? Yes or no, kids?